Good afternoon, everyone. Thank you very much for joining this panel. As Rachel mentioned, I'm Fiona Treble. I'm Global Head of Membership at AIMA. And at AIMA, we represent to regulators and policymakers globally. We represent hedge fund managers. We also represent digital asset managers. But we also have a part of our association that really looks after the interests on a regulatory front for our private credit managers, because that's definitely an asset class that we've seen grown over the past, I would say, 8 to 10 years. So the title of this panel is Asset Class du Jour. We've got 30 minutes to cover something that's quite wide, in some cases quite complicated, but hopefully this will give you a view of where private credit is at the moment and where it's going to be going. I've got a panel of experts, so I'm really delighted to be moderating you all. So in the first instance, could I, starting with Brendan, ask you all to introduce yourselves, your companies, your strategies? Thank you.
Of course. Hi, I'm Brendan Carroll. I'm the co-founder of Victory Park Capital. We are an asset-based credit firm focused on the technology and high-growth sectors around the world. We were founded in 2007. We manage approximately $8 billion in assets and have deployed about $10 billion in that 17-year period.
Gabriella.
Yes, good afternoon. I'm really delighted to be here. I have been fortunate enough to see the emergence of this asset class in the last 20 years. When we started out, we had, we talked about 20 billion, and now we are talking about over 1 trillion. I have been working for one of the largest allocators and asset managers in private credit, and currently working as a non-executive director with several organizations, among others, Neptune Leasing, where we focus on maritime investment opportunities.
Hi, everybody. I'm Julian Schickel, founding partner of Avellinia Capital. We focus, just like Victory Park, on asset-based lending in the private credit space, albeit in Europe. And given Europe, as so often, lags the US a little bit in development, we were also founded about 10 years after Victory Park. We are equally focused on data and technology-driven businesses. And with that, I'll hand over.
Thank you, Julian. I'm Pierre Garnier. I'm an investment director at 17 Capital. We have a presence in London, New York, San Francisco, and Paris. I sit within the London office. At 17 Capital, we are a NAV finance player. We actually pioneered the NAV finance markets in 2008. Since then, we've deployed roughly $10 billion of capital across close to 100 transactions. And just very quickly, what is NAV finance? It's a segment of the private credit industry that provides financing solutions to private equity asset holders who all have in common the fact that they do not want to sell, and they want to use the future cash flows of these holdings to secure capital from us or from another NAV finance player. Delighted to be with you here today.
Thank you very much, everyone. So could we have the first slide, please? So while they're getting that up, what I want to ask the panel, starting with Gabriella, is the performance of this asset class has been outstanding. There are very many reasons why you would want to be involved. So, could you just begin with some of those main drivers of return and some of those main reasons why people should consider private credit as a part of their portfolio?
Yeah, so a couple of key highlights I want you to take away today is private debt is more than return only. And in the last 15 years, the most important reasons why I saw investors getting into this asset class are A, diversification, B, return, ESG considerations, and the fourth, which is probably the most important reason that you may consider today, is a defensive asset class. So if you look at the capital structure, it's mostly at the bottom of the capital structure, so either senior debt or mezzanine debt. However, please put the slide second here. Before you analyze private credit opportunities, it is very important to understand what we are talking about. every single one of us represents a very different opportunity here. Very different. So there are many segmentation opportunities of private credit. Just look at the purpose. Who are the lenders? It can be private equity backed or non-sponsor backed. What are the geographies? What are we talking about, secured or unsecured? Based on the rating. So there are all kinds of dimensions where we can classify private credit opportunities. And what I love about private credit is when I have a talk with a client, I ask the question, what is the objective you want to achieve? Because with all these different risk and return parameters, tenors, some self-liquidating, some not, risk profile, even securities, the different coupons, some cash, some non-cash, you can achieve different objectives. And last but not least, the most important challenges in the world today, like climate transition, most happen and need to happen via private debt and private market opportunities.
Thank you, Gabriella. Pierre, moving on to you, you mentioned in your introduction that you're in the NAV financing space, and I think it's fair to say that's a relatively newer strand of the private credit family. Do you think you could talk a little bit about, the opportunity, the attractive features of this particular strand of the asset class?
Oh, of course, absolutely. And I agree with you. That's probably the newer subsegment of the private equity asset class. I would agree with that. Although it's been around for a long time. When we started in 2008, that's now 15 years of operation. So it's not a new product, but it's now a product that has a name and that investors clearly situate within the private credit space under the NAV finance umbrella. It's a very exciting opportunity, and I think there are many reasons for that. But to me, if you ask my opinion, the one very exciting feature of the asset class at the moment is the growth. It's the growth that it represents. At 17 Capital, we are not the market, but I think we are a good proxy for the market. At 17 Capital, we screened in 2022, I think it was $35 billion of deal flow. And that was, at the time, 3 times the amount of deal flow that we screened 3 years before in 2019. So the growth is very, very rapid and very strong in this segment. All the indicators are in green for 2023 to be a year where we would be screening anywhere between $40 to $50 billion of deal flow. So the growth is there, and the drivers behind that growth, it's very much, and that's the exciting bit to me, if you ask me the question, it's very much the fact that the best-in-class private equity managers, they are now using NAV finance as an integral part of the private equity toolkit, of the portfolio management toolkit. 20 years ago, there was the operation of the sublines, for example. It's now a very, very common and used feature. Then the secondary market became more and more of an option for these managers to be not only good at creating value at the underlying portfolio company level, but also to add this layer of positive portfolio management. And within that toolkit, you now have NAV finance, and clearly the top brands in private equity are either all using it as we speak or strongly considering a NAV finance product solution across their platform at a given point in time. So that's, in a nutshell, that's what I find exciting about the opportunity at the moment.
Thank you. And you've mentioned private equity managers, and when we were doing the prep for this panel, I think we were discussing, Julian, about how private credit is gaining a little bit of a stand over its private equity cousins. Is that fair?
I think that is absolutely fair. If we just think about one of the key aspects of today's environment being rates are no longer negative or at zero in the developed world, that's a positive for private credit, a net positive. And many market observants and players think that, and I would agree with that, last year's and potentially next year's private credit vintages will be amongst, if not the best that we have seen so far. Why is that? Because most of private credit is floating rate for starters, meaning that you actually generate higher returns in this environment. Whereas if we look at private equity, clearly the cost of borrowing has gone up significantly. So while private equity remains an attractive asset class, this goes directly net out of private equity returns, that cost of borrowing for leveraged buyouts, et cetera. Private credit can deliver consistent yields, in some cases of distributing nature, if that's what investors are looking for. And these are yields that are less, or in some cases really not correlated to public markets. Obviously, that comes at the expense of liquidity, and in some cases, in many cases, at the expense of complexity, or at least perceived complexity. So private equity, private debt, private credit managers need to do a better job, I think, at explaining those complexities, given now everybody understands how private equity works largely. I think if you additionally look at what the environment means, the interest rate environment that is, and the macroeconomic environment, the uncertainties we see in the world, that means private equity, providing leverage to finance company buyouts certainly has become a riskier business, and you can't know, the rising tide is no longer floating all boats, so you need to be much more discerning, and that is true, of course, for private equity as it is for private credit. But if we think about what one of my co-panelists here already said, obviously we are looking at an environment where, if you look at private credit, you tend to have the equity part of the capital structure underneath you, i.e. subordinated to your risk position, so you're in a de-risk position.
Thanks, Julian. And Brendan, I just wanted to ask you this. What other opportunities are you seeing in the market for managers in this space? And you had some really interesting views on what's happening with insurance companies.
Sure. I mean, 10 years ago, when you walked into a room to meet a potential investor, typically you had to first convince them that private credit should be part of their asset allocation model. And then once you're able to convince them of that, then you have to convince them that they should invest with you versus somebody else. Now, thankfully, private credit has become more of a mainstay in most asset allocation models. The first place we went when we were raising money 15 years ago was actually here, because a lot of the sovereign wealth funds are very sophisticated here, and they didn't have to abide by the same asset allocation models that pension funds or university endowments have to. So interest rates providing very little to no return in liquid credit for a decade finally forced the consultants and everybody else that helps shift that allocation capital to new strategies to look at private credit. And specifically within the insurance company industry in the last really 5 years, typically if an insurance company had $1 to invest in alternatives, at least 95 cents of that had to be in something that could get a rating for their own capital efficiency needs. Finally, now you're seeing we're not just going after the 5 cents anymore, which doesn't really clear their hurdle. You can get a rating agency, and we've done this now multiple times, either in our multi-investor funds as well as single managed accounts, to allow those insurance companies to get the structure and the capital efficiency they need on their own balance sheets. It doesn't change how we operate or lend, but it opens up a massive pool of new capital, especially in the US, that is seeking yield and now can efficiently invest it without having to worry about what sort of charge they're going to take on their balance sheet.
Thanks, Brendan. And Gabriella, we published a paper actually a couple of weeks ago on trends in structuring private credit funds. And a couple of things came out of this: retailization, evergreen funds, and these were seen as positive trends, opportunities. Have you got any views on that?
Yeah, sure. As I mentioned, all these opportunities address client needs and the needs of liquidity in this specific case. We have seen it also in leveraged loans, the broader syndicated transactions that now appears in private credit. It needs to be managed properly. So I think we need to highlight that because liquidity disappear or might disappear quite quickly. In addition to evergreen fund structures, we see a number of other trends that are worth mentioning, like specialty finance, focusing on the energy transition related financing opportunities, some sector focus opportunities. So many opportunities where banks are withdrawing from the market. And then we need to ask ourselves, how do we add value to our clients? How we bring down complexity? How we add value with our knowledge? And that's, in my view, something which is sustainable, the only sustainable. And the world has changed quite a lot in the last even 2 weeks, yeah? And how we add value is quite different today, how we used to add value. And in my view, there are 3 things I want you to mention that, in my view, should be new in your consideration how to approach private credit. One is we need to bring in optionality in how we structure credit and how we take advantage of the opportunities overall. If we don't know how to manage risks, and nobody knows how to manage risk in current environment 100%, then we need to focus on diversification. And the third is, the risk is very high in current environment, and you need to seek alignment. We act very often in an information asymmetry environment. And the question is how you bring down this information asymmetry. So you seek alignment of interest with all your stakeholders, whether it's private equity, owners, or other stakeholders. You need to diversify risks. And that's a way for me to add value.
Thank you. So we've spent half of this conversation hopefully highlighting the opportunities and the positives around private credit. We want to offer a balanced message here, and obviously there's negatives as well. I think it's fair to say that the asset class has faced a really difficult asset raising environment. So I'd like, Julian, can you start by offering some colour around that?
Yes, absolutely. I mean, stating the obvious, this environment is very, very different to a year and a half, 2 years ago. And that also applies to fundraising. Some of the larger managers continue to have significant inflows, but it's certainly fair to say that the smaller, the more specialized managers have struggled more than the larger managers. Why is that? I think any change or significant change in environment always takes time for adjustment on the investor side, obviously. We should not forget one thing. There's a whole cohort of, in some cases, very senior people in the industry, including analysts, portfolio managers, even chief investment officers, who haven't seen positive rates environments because they've only been in the market for 10, 15 years. At best, they may have spent a year or two in that. So while allocators and investors work through that, clearly it is fair to say, and while you can generate 4 to 5, in some cases 6% of quasi-risk-free returns, it is fair to say that it's an easy choice to postpone, while you're working through those issues, your allocation to a perceived as higher risk or certainly requiring more analysis, smaller managers. So yes, fundraising has been tough for us, for a lot of our peers.
Brendan, have you got anything to add to that?
Yeah, it's a double-edged sword, to stay on the insurance company theme. Typically, private credit is going to have a benchmark anywhere from 300 to 500 basis points above prime. It's going to vary whether you're an endowment, pension fund, etc. For obviously a decade, when liquid fixed income was generating very, very low returns, generating a 5 to 6% net return was attractive. Well, that's obviously not the case today when you could generate a 5+% return in treasuries. So you're seeing a lot of allocators who have the ability to pivot quickly for the time being, not permanently, shifting more of their capital back to liquid fixed income because it's not worth the 100-200 basis points of illiquidity premium that's being generated today. But again, most allocators we've seen have made the commitment that private credit will be a mainstay and they'll still build out their portfolios. But there are many different types of private credit strategies that exist today, so there's more competition. So, there's a multitude of factors that also will work against. But, if you've been doing it a long time and you have a long track record through cycles, and depending on what your strategy is, and thankfully our net returns still clear that hurdle, but not by nearly as much as they did when interest rates were at zero, it's still a mainstay in those models. But allocators will shift back and forth between private and liquid credit based upon their own benchmarks and where liquid credit trades.
Pierre.
Yes, sure. A lot has been said already, and I fully echo with your comments, especially Brandon, on this sort of back and forth between listed and private equity allocations. On a sort of positive note, if I may say, I mean, yes, it is a challenging environment. 2023 has been a challenge fundraising environment. I think we all agree with that. And it's not finished yet. I mean, the mood seems a little bit more positive for new allocation in 2024, but is it wishful thinking? We'll see. At the moment, the environment is challenging for any managers in fundraising modes. Looking at it probably a bit more positively, I would say that on a relative basis, relative to other asset classes, such as private equity, for example, private equity is relatively well positioned for the risk-return characteristics that we were mentioning earlier. It remains a very attractive proposition to investors, a proposition that travels well across cycles, across time, for whoever is looking for relative value and stable returns. I'm naturally biased in saying that in NAV finance, it's very much, we believe, the case through the downside protection that we offer via the diversification of our portfolios, of our investments, and the low loan to value that we use in every single of our structures. That's appealing characteristics to investors. Now, does it make the fundraising efforts easy? Absolutely not. Having said that, I remain personally very optimistic about NAV finance and the private credit asset class in general. It has demonstrated a strong growth over the last decade to 20 years. And I personally believe, and at 17 Capital, we do believe strongly that it's here to stay and it's here to grow through the cycles.
Okay. I'm going to move on now to another feature of the environment that's come up on various conversations in various papers, is that the bigger managers do appear to be growing and getting bigger. And how is that impacting the asset class, Gabriella?
Of course, when I started my career, the first fund of ICG was, I think, 500 million range, and now it's over 10 billion. So you can imagine if you have a diversification of 15 names in the portfolio, you are clearly moving up, and there is a risk of style drift. However, on the other side, banks are moving away also from smaller companies. So it gives a very interesting opportunity for us private credit providers to finance smaller companies that have huge ambitious targets, want to contribute to net zero transition, and these are all in private market segments. So this creates actually opportunity for all of us, like smaller companies, and I think we will see quite high risk-adjusted return and premium for these opportunities in the future.
Julian.
Yeah, I just want to add one very brief remark to that. If you're looking for diversification and for additional risk-adjusted return, you want to look for smaller managers. If you just allocate with the largest managers, you're buying the market, and that at some point becomes market performance.
And Brendan, you had some views on sort of smaller managers versus, well, not versus, but the difference between maybe how consultants and some investors might approach the allocations.
It's a bit of a cynical view, so I'll apologize for that.
There's no problem with that.
And I always jokingly say, if you're a gatekeeper or an allocator, whether you're a consultant, pension fund manager, et cetera, you're not going to get fired if you allocate to a brand name fund, Apollo, Blackstone, PIMCO, and the fund does poorly. You're not going to lose your job. If you allocate to a newer manager that doesn't have that same name recognition and the fund does poorly, there's a lot more risk involved. So that's one facet that works against it. And then two, the larger managers, they have the advantage of large sales forces, so that they know that if Tokyo Marine's going to increase their credit allocation by 50 basis points in the next 2 months, and you need to be in front of them, and that's just harder for smaller managers to have all that information at their fingertips. But at the same time, smaller managers that focus on, call it less efficient strategies or markets, ones that aren't as large, they can still generate good return. And again, now with more and more people looking to have private credit in their portfolios, it does open up opportunities. But for sure, depending on the strategy, those larger managers have a distinct advantage.
Pierre, you had a slightly different view to the rest of the panelists regarding larger managers?
No, I clearly don't disagree with what has just been said. And I probably am a bit biased by the fact that, I represent 17 Capital, and what we do is NAV finance. We finance the NAV, and those larger managers, they are the ones most often than not that actually offer us the quantum of NAV that we need to, structure sizable transactions.
Yeah.
So that's by nature a little bit our ecosystem. Having said that, we see value in the small cap, the mid cap, and the large cap end of the segments. And we have tremendous amount of respects for those high quality, specialized, a little bit more niche but very focused small cap managers. If I look at it slightly differently, if these large cap managers have become what they are, surely they must have done something well.
Yeah.
Right? That's the way I look at it. It's probably a bit simplistic, but still, you don't grow your AUM consistently across cycles just based on a fantastic marketing force. At the end of the day, you need to have a track record that you sell to the market, and private assets allocators are very sophisticated and they read through the numbers. So yes, we see value across the value chain of the industry. We tend to focus on the larger end of the market simply for positioning reasons, and we do as well finance the smaller managers, absolutely. It's just that all other things being equal, we feel that should you ask for an alpha on your equity returns when you go smaller? Yes, because all other things being equal, you somehow take a little bit more risks, at least at the governance level, versus a bigger private equity setup.
Okay, thank you.
I think
Gabriella.
structural features are super important here, and I do feel that Europe is lagging behind in comparison with US to support some small emerging managers. The key question to ask is alignment of interest. What is in it for whom? And how you mitigate your risks as an investor. Definitely, you need to look at alignment of interest in terms of first losses.
I agree.
Thank you. And presumably, if you're investing with a smaller manager, you are taking a slightly larger risk, and you probably, as an investor, do need to see some alpha generation.
I don't think you necessarily have to add risk, but you certainly need to look at return profiles that are not accessible for one reason or another to larger managers, and that's often because of the size and the niche.
We're drawing to a close, so I want to make sure that we do end on a very positive note. So what have private credit managers, investors in this space got to look forward to? What are the positives, do you think, that are coming down the line in the next 12 to 18 months? I'll start off with Pierre and move down the line.
As far as we are concerned, we are very excited about the growth of the opportunity set.
Okay.
And my comment would be a bit more specific to NAV finance here, but I think it applies as well to the broader private credit industry. As I was saying earlier, we benefit from a deal flow that is growing year by year, that is threefold what it was 3 years ago. And we have all the reasons to believe that it's going to continue. It's here to stay, and it's here to grow. The segment is already generating huge amounts of deal flow, while the penetration rate is actually relatively still quite low. So there is a lot of things to be done and to be achieved, whether it is to finance the management companies, the funds, or their limited partners. There are plenty of solutions that have now been tested across both sides of the cycle. They have demonstrated that they work. They have demonstrated that they create a win-win between the NAV finance provider and their counterparts. But NAV finance providers are now very well equipped to address the needs of the whole industry, because our fund size have been growing, because we've built a track record and the experience, we've learned from our mistakes, and the market continue to offer a very attractive risk-return profile to these LPs who are entering the asset class. So yes, very excited about the future. There will be some ups and downs. We are in a challenging fundraising environment, we all agree. But looking at a bigger picture for the industry, very optimistic and excited about what lies ahead.
Julian.
We're seeing extremely attractive risk-return profiles at deal level across regions, and this will likely continue for the foreseeable future. So that means, and at the risk of repeating myself, very attractive time to enter and attractive fund vintages looking forward. Some others, including Steve Schwartzman, have called this the golden age of private credit. I would tend to agree.
Yeah, I think all agencies agree that private credit is set to grow slightly higher than private equity. In my personal view, the risk-adjusted return in private credit is better than for private equity because the first loss of the potential revaluation risk is taken by the private equity industry, not by the private credit. So for me, it's a fantastic opportunity to enter. Some new interesting areas will be, of course, distressed opportunities, dislocation opportunities. And some of the sub-segments, like energy transition and the investment needs that we have in Europe are going to raise 40-50% annually. So who is, like the North Sea offshore markets, who is going to finance that? Private credit. So look at these niche opportunities and ask yourself, it's not return only, how am I contributing to the most important challenges of the world and make an impact? We don't have a lot of time to make an impact.
And last but not least, Brendan.
Yeah, I think timing plays a big factor. Private credit funds that were allocating 2-3 years ago now have companies in their portfolio where I don't care what the business model is, I don't care where they're located. When your cost of capital increases by 25 to 50%, most business models are not set up to have that prolonged. As we sit today and you're deploying new capital and what is the new normal in terms of elevated rates for longer, you're going in eyes wide open in terms of structuring and understanding the companies that you're lending to understand what that cost of capital is going to be. So it's just a safer environment, so to say, and that risk reward is a lot higher than it would be in funds that put that capital out 2 or 3 years ago. I don't care if they're floating or not. Those companies are not set up to pay that price for a prolonged period.
Well, I'm afraid we're out of time, but I'd really like you to join me in thanking our panelists for giving us a really good insight into private credit asset class du jour. Thank you.